This episode of the Old Dogs REI Network is brought to you by Mino Studio.
In a world where jobs are how most people make money, one man, one desire, one challenge dares to break the mold. Welcome to the Old Dogs REI Network, where we don't work for money. Money works for us. Coming soon. Viewer discretion advised.
Welcome to the Old Dogs REI Network, where cash flow is king. Real estate investing, the means, so you can enjoy your retirement dreams. This is the show where we cut right to the chase. No sales pitch, no long monologues, just simple how-to real estate investing advice, so you can earn the passive income you need to enjoy your retirement today. And now, your host and chief old dog, Bill Manacero.
Welcome to the Old Dogs REI Network. I'm your host, Bill Manacero, and this is a show where 50-plussers and anyone else who wants to join us get solid, no sales pitch real estate investing advice to help generate real cash flow. This podcast airs twice weekly on Mondays and Fridays, and if you aren't already a subscriber, go to iTunes, type in Old Dog, spelled D-A-W-G, find our podcast, and subscribe. Well, today's show, I'm really looking forward to. We're having a repeat guest on the show, Nizan Mosery, who has a great background in multifamily especially. And today's show is really going to be looking at funding your first big deal. So we're talking multifamily here. We're talking units of apartments of 100-plus units. And how does somebody move into that stage? But first, let me tell you a little bit before we get started about Nizan. He's been involved in real estate for the past 20 years and currently owns over $120 million in properties nationally and internationally. On his background here, while living in New York, he owned a construction company and worked on numerous single-family homes, multifamily, and commercial projects of up to 300 units. In 2009, he relocated from New York to Florida and became a licensed real estate professional serving the South Florida market. He owns Keen Realty Solutions, a Florida-based real estate brokerage firm and one of the first commercial RE/MAX franchises in South Florida. Nizan and his team head up the multifamily division. He is also the owner and CEO of Keen Management Solutions, a hands-on boutique professional property management company. His background ranges from managing commercial assets, recognizing emerging markets, property management, syndication, mentoring, and advanced creative financing solutions. So, wow, what a great background, Nizan. Welcome to the Old Dogs REI Network again.
Hey, Bill. It's a pleasure to be back on. Thank you so much for having me.
Well, as I told you in our last time we interviewed, I said, gee, you have too much information here. We're going to have you back again here.
Glad to be back. Absolutely.
So how have things been going with you?
Things have been going pretty well. Can't complain. Knock on wood. Thank the heavens. We've been disposing of some of our assets. We have several assets under contract as well currently. We've got a 380 unit in between Orlando and Tampa that we've got under contract. We're inches away from inking another contract in Kentucky on another 300 unit complex, and both of these complexes have very strong upside potential to them. We bought a hotel as well in Memphis that we're renovating and we're working on. So things are really going well. Last year also, we acquired, at the beginning of this year, I believe we closed on a marina that we were taking out the RV campers, and we're bringing in vacation cabin rentals. So in the last 2 weeks, we've had a big shipment of vacation cabins coming into our property, and we've been installing them. So it's been pretty interesting and pretty exciting at the same time, and very active.
What a blast! And you're all over the commercial areas there. That's fantastic, from hotels to marinas to apartments. That's amazing. Do you ever slow down?
Well, I'll sleep when I die, basically.
Well, it looks like you love what you do. That's what's important, right?
Absolutely. I enjoy it. It gives me time to spend with my family when I need to. It gives me time to travel, to look at all these different assets. It gives me the opportunity to meet amazing people such as yourself and a lot of other people that I've enjoyed meeting throughout my time here in South Florida. It's been a great ride.
Yeah, I mean, we're talking right now, it's December 29th. This will air at a later date, but, you've already told me just how you're suffering through the weather out there.
Yeah.
You're really roughing it. What is it, 80 degrees and blue skies? Oh, my goodness.
Yeah, it's tough, but somebody's got to do it. I'll take one for the team.
All right. We just love that self-sacrificial attitude. Well, we've got a fun kind of show. It's a little different than we normally do here. What I'm going to do here is I'm going to present you with a situation. Mm-hmm. And okay. Using your experience and even sharing your own personal examples and so forth, I would like to, get your feedback on how you would approach this, because there are listeners. We have all kinds of listeners. We have those that are just beginning. I mean, they're even thinking about it. They haven't even started yet. We have some that maybe have a few rental properties, and then we have others that are pretty well along. They've got a number of rental properties, even some small multis, and but that move from, let's say somebody has maybe some single family, a few duplexes, maybe even a 16 unit. But now they really want to get into those properties that really are sort of the cherry of the multifamily world, those 100 plus units, 200 plus units. And that takes a whole different ballpark. You can finance small multis on your own, but now we're looking at moving into this different realm. So what I'm going to do is I'm going to lay out a situation, a imaginary person here who has a good credit, history, and maybe in the 720s, 740s, something like that. They again, they financed all their properties have some sort of mortgage on them, maybe a commercial mortgage on the 16 unit and so forth, and so they have some experience there, not extensive experience, but nonetheless they have some background with multifamily. They find this property, and it is 154 units. It's what would be called a Class C apartment, built in 1975, but it's in a B minus area. It's a little outdated. Still got a lot of the accrements of the 70s, late 70s. Definitely needs upgrades, some exterior landscaping. The potential buyer here might want to add some amenities. It doesn't have a pool, so a pool, a dog park, picnic barbecue area, for example. And it's a good emerging market that looks like it's really on the way up. The purchase price is a real deal at $5 million. It looks like there's indicators that just in the earliest assessments that it may be anywhere from 15 to 20% under value. But it's going to require at least 250 in upgrades, maybe a little more. Rents are also under market. It's owned by a mom and pop owner who really likes their tenants, have relationships with their tenants, and really have difficulty raising rents on them. It does have on-site management. It seems like they're doing a decent job. But the mom and pop owner, they've owned it for 20 years. They're in their 80s now, and they've loved the income, but they're ready to sell. So that's the situation. Guy has found this property, but doesn't have anything lined up yet in terms of how he's going to buy this property. It's going to take at least, he figures, 20% down. So he's going to have to come up with $1 million, to get into this, let alone financing. So here it is. That's the dilemma. Nizan, go to it. What would you do in this situation?
I would buy it. The way you're describing it, this is a perfect property for us. The only one thing that we might have some issues on is the year that it was built in 1975, and the only reason why is and again, it just depends on your buying criteria. With real estate, there are so many shiny pennies. You can buy properties that were built in the 60s. You can buy properties that were built in the 80s and the 90s. You can buy a property that was built last year. You can buy a property that is being currently under construction. So it all depends on what your buying criteria is. But if you can take a 1975 and it's a C property, exactly like you said, in a B- area, that's a great thing, because you can definitely do renovations to the property and increase the value of the property, especially because it's in a decent neighborhood. So those two criteria we look for very strongly is the year of construction on the property and the location. We always want to look for a property that is in the path of progress, in a strong growth market, a market that has, I would say, at least 2 to 3 different economic driving factors. For example, government jobs, healthcare, education, there's technology companies coming in, things of that nature. So if one of the industries has a hiccup, you still have the other 2 or 3 economic factors that'll drive the market. But let's just go over it quickly. So you said it's a 1975 build, and that's okay. And the reason why we might have an issue sometimes is because we like to hold properties anywhere between 3 to 5 or 5 to 7 years, depending on the type of renovations or repositioning that we have to do. So if there's some major renovations that have to be done, then we may want to hold it for a little bit longer so that we can do all the renovations, get the right demographics of tenants in there that can pay the higher rent, and get that NOI up for a while so we can show a definite proven track record. That way we can sell it off a few years later at a higher cap rate, or actually a lower cap rate at a higher value. And when you go to sell it within another 5 to 7 years, that 1975 property just became that much older. But again, that is one little tiny strand in the whole pool of hay that we're looking at. If we can take that 1975 and really make it pretty, and we want to look at that point at the configuration of the apartments. Are they big? Do the layouts work in today's modern times? People like more open floor plans, So we kind of look to see if there's a lot of planned obsolescence that we can get rid of. If there's a design obsolescence that we can take care of, then we would look into it. And also, if the upside is truly great, really, really there, then we would look at it as well. 154 units, that's fantastic. Needing upgrades, exterior, landscaping, and so forth, that's fine. We usually tend to look at properties that have what we call deferred maintenance. Just like you said here, this is a mom and pop owner, which is fantastic. We love mom and pop owners, and I'll get into why we like them in a minute. But these guys, as you've said, have not raised the rents. They really haven't done anything to the property. So this is our value add. This is where we can add value. We can come in and we can spruce up the outside. We can make the exterior pretty by painting the exterior. If the roofs need to be replaced, we can replace the roofs. We can do the parking lots, retrim and repaint the parking lots. We can do the clubhouse. We can go inside to the units and upgrade the units. All that we will do. We will check when we have our due diligence period, our inspection. We'll go in with our property management company and we will inspect every single unit, and we'll get from them a complete breakdown of exactly what needs to be done in every single unit and how much the total cost will be for all these renovations. And then we will go back and we will underwrite using those costs and see where we are. Buying a 16-unit property and a 154-unit property, the process is the same. You're looking at the property, you're underwriting the financials, you're going to do your inspection, you're going to talk to lenders, you're going to have the title companies pull title and lien searches and all that. You're going to have to talk to the utility companies to see what kind of deposits they require for the asset. Can you put up a bond instead of coming up with a deposit? Can you go to a bank and get a letter of credit rather than coming up with a deposit? All these things. So the process is the same. The only difference is the size. Let's say for a 16-unit property, let's say we're talking, I'm just throwing out a number here, $500,000 rather than $5 million. So instead of coming up where you would have to raise $150,000 or $200,000 for the 16-unit property, you would need to raise $1.5 million, maybe $2 million for the $5 million property. So the numbers are just a little bit different. People kind of get scary and freaked out to go, oh my God, oh my God, oh my God. And yes, you should go, oh my God, because it's stressful and there's a lot more to be done. However, the process is the same.
At this point, you've made your assessment, you've even maybe done the inspection. I'm not sure actually where it would fall in there, but do you submit an LOI initially, or do you actually go right to contract? How would you try to hold this property so that you can do the due diligence?
Well, the first thing that we would do is we would submit an LOI. With an LOI is a letter of intent, and today we have a letter of intent and a letter of interest. And some people will say, I want a letter of interest. No, I want a letter of intent. It's 6 of one, half a dozen of the other. It really makes no difference what you call it. Basically, the letter of intent tells the seller, Mr. and Mrs. Seller, we want to acquire the property. This is the purchase price that we would like to acquire it. This is the time frame that we would need for our due diligence. This is the time frame that we would need for our financing contingency to see if the property can get financing, if we can get financing on it as well, and our closing date and how much time we would need. What we would also indicate on the letter of intent, and for those of you listening, this is a piece of valuable information. This is a nugget. So if you're taking notes, this is something you really want to write down.
Be in our show notes too, just so everybody knows, just in case you're driving and listening to this, know that you will be able to access this at our website at olddogsreinetwork.com.
Great.
Go ahead.
Great. So the one thing that we learned is that we've, and I'm talking from experience now on closing many different properties and different types of assets as well, with different types of owners, not necessarily just mom and pop owners, but also institutional owners. So we've come across where at times we've had owners, for whatever reason, mom and pop, they couldn't find it, they didn't have it, it took time to create, whatever it was, where we asked for certain documents and our clock on our due diligence period was running. And then a week before our due diligence period was over, we would get the last piece of document that we needed 4 or 5 weeks ago. So what we also decided to input into our LOI is a phrase that says, the effective date shall begin once all documents that are listed in our letter of intent have been submitted to the buyer and have been signed off on by the seller as being true. So what this does is, and in our LOI we have an exhibit, Exhibit A, and it lists all the documents that we require from the seller to give to us. For example, the financials, the trailing 12, the trailing 24 financials, income and expense reports, the current rent roll, and all this is in Excel format. We want all of the leases of all the tenants. We want all of the forms that they filled out to be qualified. We want to see them as well. We want all the contracts from all the vendors that the owner is working with. And we want all this in time so that we can review it. We can give it to our attorneys to review if they need to review certain documents, and for us to review. And if you're doing a 154-unit complex, you want to review every single lease to make sure that the rent roll that we were given by the sellers is the same, that is exactly the same as what it says on the leases. Sometimes we have sellers that let the property manager live in one of the sites in one of the units, or we have, whatever, and it's not listed. And you just need to verify that everything is true and correct, and you want to do it immediately so that you can move forward and not be delayed. So that's very key. So the way we word it is, effective date shall begin once buyer has received all documents listed in the LOI. So if they start giving you the documents the day that you sign the contract and the contract is executed, and they give it to you within a week, well, as soon as that last document hits you, that's when your due diligence begins. So that's really important. So that's why we want to have an LOI. The LOI is where you hash out all the terms, and then from there we tell the seller to go to their attorney and to get a contract. I don't like to use the word contract, a purchase and sale agreement together with the terms and agreements that we've had a meeting of the minds with on the LOI, and then send it to us. Now, a lot of people say, well, why don't we do that? Why don't I get my attorney to write up a contract? Well, we're in this business to make money and to make money for our investors. So by looking out for my team and my investors, I want the seller to go to their attorney and for them to spend the money to have their attorney create a new purchase and sale agreement for us. Then all I have to do is take that purchase and sale agreement with my LOI and submit it to my attorney and say, hey, please make sure that the PSA, the purchase and sale agreement that we received, everything is okay. It's not one-sided. It's equally, it protects both parties equally, and that all of our terms in the LOI are included in the purchase and sale agreement. Like this, it's a lot less headache for my attorney, and it costs me a lot less money doing it that way.
That's great.
Does that make sense?
Yes. Maybe if you could just take a step back a little bit here, describing a time frame here. So let's say you submit your LOI on day one. Mm-hmm. Now, do you have a time frame on your LOI that this has to be signed by this date?
Yes.
When do you expect to get that back?
Yes. In all of my LOIs, I have at the end, this letter is valid for 5 business days.
Okay.
From the date that it was submitted.
Gotcha. So 5 days. Okay, so you submit the LOI. Let's say on the 5th day, you get the LOI back.
Right.
Okay, and then at that point, how much time do they have to come up with the sales agreement?
Now, in the LOI also, we put in that the seller and the purchaser have up to 10 business days to sign to execute the purchase and sale agreement.
Okay, gotcha. So you have another 10 days there.
Right.
At this point, are you doing any due diligence during this process until you get the signed contract?
Well, the due diligence that we do to submit an LOI is I will always ask for the updated current rent roll and the updated trailing 12 financials. Trailing 12 means if we are now December, let's say we're in March right now, okay? We're not in December. Trailing 12 is from the date, from today, going back 12 months. It's not the actual 12-month calendar year, but it's 12 months of working days. So if we're in March, I will ask for the trailing 12 to go from March all the way back to the previous March. I want to see all the income and expenses. If they did any renovations, I want to see all the renovations and how much money they put into it. Then what I would do is I obviously, my business partner and I, and she is she's the master at the spreadsheets and Excel and all that. So she created this incredible spreadsheet for us, this underwriting spreadsheet. So we go and we put all those numbers into the spreadsheet, and then we look, depending on what market we're in, we know what the rules of thumb are for that particular market and what we can do as a team, how we can run that property. And then we put our numbers in there. So that's the kind of due diligence that we do in the beginning to come up with the purchase price that works for us. And then we'll submit it. And of course, once we get the contract and we get all the other documents, then we really go deeply into that financial due diligence. And then we have the inspection. Once we said, okay, we have the financials are okay. We see what's going on. We check that the capital expenses that the property, that the seller has done. Now we're going to have the inspection.
Now you have the signed sales agreement
Yes.
in hand? Okay, so the
Yes.
second you have that, then you actually go into that real hardcore inspections.
Yes.
Okay, gotcha.
Yes.
Now what's your the next time frame now? Between that and purchase, actual escrow, how much time do you build into your contract there so that now I mean, I'm using this person as an example. Now they got to hustle here.
Now you got to hustle.
Yeah.
Now sleep becomes a secondary thing.
Right. So
Okay.
tell me what that time frame is.
So now we also say that now in the LOI and in the contract, we forgot to talk about one thing is the earnest money deposit.
Oh, yeah. Okay.
The earnest money deposit, I like to always put 1% of the purchase price. So if we're doing a $5 million purchase price, I'll put 1% as the earnest money deposit. Okay? And that will probably be, up to 5 business days after we've executed the purchase and sale agreement.
Okay, 5 days after. Okay, gotcha.
Now, these terms, these numbers, I got to say this. The market now for multifamily is very hot all around the country. Okay, and brokers are pushing and they're pushing and they're pushing because that's what brokers do. Brokers make money once the deal is closed. And I'm a broker, so I can say this. Does a broker really care if you're going to make money on this deal once you've closed on it? Not really. They don't care. Okay, the good ones do care because they want to build a long-lasting relationship. They don't want to just sell you a one-off. But the guys that are just out there that are looking to make deals happen and just to get that commission, they don't really care if you make money or not. So when you're going in, what we have to do with the time frames, okay, a lot of the brokers will push you and say, sellers want 30 days to do your due diligence and then 30 days to close after that, 60 days. Now, that's great if you've got $2, $3, $4 million, even $1 million or $500,000 sitting in your bank account where you don't have to go and raise that equity on a syndication. Then you can do that really, really quickly. However, if you're going to do a raise with a syndication, if you're going to go out to your friends and family and to your network to raise money, you're going to need time to do that because you're going to need now another type of attorney, a securities and exchange commission attorney, because now you're selling a security as well. And that goes into a whole other topic of syndication and the laws, what to do there. So in our LOI, we like to put, and now we like to put terms in also sometimes that we know the seller is just going to cross out. We know, but that gives them a feeling that they have a say in in the terms that they want as well. So what we'll put a lot of times is either we'll put 30 business days or 45 calendar days, or if it's a really big property, we'll put 45 business days to do our due diligence.
Okay, gotcha.
Okay, and then also we have to get our financial contingency. Financial contingency means we're talking to a lender, we're talking to a bank, we're talking to a mortgage broker. The property has to get qualified, and the buyer, the key principal, has to be qualified. And we're going to talk about who that key principal should be and what it looks like for them in a minute. So when you have that timing now, it depends on the time of the year. Like now, we're putting a property under contract. Things are moving very slowly. Everybody's on holiday. Everybody's away. Everybody's trying to close that last deal before the end of the year. So timing is really, really slow. And what happens when you get your LOI accepted, and usually now, if the property is a really hot property and it's in a really good area and it has really strong upside, you probably won't be the only person bidding on it. There'll be other people bidding on it. So if you're lucky and you have a strong team, a strong track record, and you can qualify and you put in a strong offer, what will happen is the broker with the seller together will call for best and final. Your best offer, and this will be your final offer, is what they're asking.
Now, when does that fall in this process? Now, you haven't signed a contract yet. If
You haven't signed the contract, no. You submitted your LOI to the broker, right? Now, a lot of times, you'll get a property and the broker will say, call for offers will be in 2 weeks. The seller will not accept an offer without having at least one principal visit the property.
Okay.
Okay. So then you talk to the broker and you say, okay, here's my LOI. Please let me know what happens. And then in 2 weeks, the seller chooses 3 groups, and you're one of the groups. Okay. So then the broker comes back to you and says, you're one of the top 3 best and final. Okay. Now you're working. Now the seller can say, I want better terms. I want shorter closing dates. I want bigger earnest money deposit. I want you to come up on your purchase price. They'll come back and tell you all these kinds of things. Now remember, this is not an emotional buy. Okay, this is not a family. It's not a single family home. This is not your residence that you're buying. Emotions should not play a part in this business. This is strictly, you're buying brick and mortar. You're buying income and expenses, and the numbers should work. You should never try to force the numbers to make it work. That's when you get into trouble. So we go back at that point, and we redo our numbers, and we say, okay, can we come up on the purchase price a little bit, or can we not? We had a seller come back to us just now in one of the properties in Kentucky, and they said the buyer that was awarded the contract, they couldn't close on it. The seller now is coming to you. Would you like to amend your offer? And we said, no, that's our highest and best. And then, so the broker went back. Now, what happens? Let's say with our property in North Florida, we got awarded the contract. But before that, we were in best and final. And then once we're in best and final, the broker came to us and said the seller's group would like to have a conference call with all the principals in your team. So all my team gets on a phone call with the sellers, and they talk. They want to hear, how many properties have we closed on? How do we raise our money? Do we have the money committed, or do we have to go now and raise the money? What kind of earnest money deposit? Do we have it ready? All these questions. They want to hear who we are and if we are able to close. Now, a lot of times when you have a track record, a strong track record like ourselves, like my team, what we're able to do is we're able to come from a very confident place. So when we were talking with the sellers, and they said, are you willing to come up on purchase price? I said, no, I'm sorry. I said, I cannot do it. They said, are you willing to cut down on the days of your due diligence and so forth? I said, you know what? I said, listen, if you want us to break down the days or bring it back or shorten our due diligence, I said, we can do whatever we want. We can do whatever you want. You want 30 days? We'll do 30 days. However, we're not the type of group that'll come and will retrade with you once we're under contract. We're not going to come and nickel and dime you. You want to close on this property? We've put an X on this property as well. This is a property that we want to close on. We know what we can do. We know our time frame. We know that it will take us, especially it's almost 400 units. I said, we don't want to have any mistakes. I have a fiduciary responsibility to my investors to make sure that we walk every single unit, that we do our due diligence properly. I said to them, you've already gone with one other buyer. They did their 30 days just like you wanted, and they didn't close. You just wasted 60 days. Do you want to waste another 30, 60 days and go with someone that is going to give you your terms, or do you want to go with someone that is going to close on the property? It's your choice. If you want someone to close on the property and that's going to take this headache off of your shoulders, then you need to come with my group, because we'll make it happen. But we need to make it happen on our terms.
That's great to be able to have that leverage
Yes.
by all means. But taking it back, again, we're looking at this as somebody's first big deal, so
Perfect.
they don't have that. So
Right.
so
And that was my segue.
okay, gotcha.
That was exactly where I was coming from, because when we started, we didn't have the track record. I had a track record of doing office buildings. I had a track record of doing single-family homes, even high-end single-family homes. But when my business partner Laura and I, when we teamed up together, we really didn't have that much experience in multifamily. We had flipped a 27-unit multifamily in Leesburg, Florida. We made gross $80,000, but we didn't really have experience in syndication, in managing, in managing the managers, in selling an asset. So we didn't have that track record. So what did we do? We went and we partnered up with a team that already had that track record. Okay? We partnered up with them. We became partners on an asset, and we now became part of their team.
So that now partnering, explain what you mean partnering up with somebody else.
Okay. When you do a syndication, okay, a syndication means that you're going out to other investors, you're raising money, and they are now going to become the limited partners in that investment. Okay, we create a limited liability company according to how the lender, the bank, wants it to be formed. So usually they'll ask us to create a limited liability company, an LLC, that will take possession of the property. And then the sponsors, the people who sign on the loan documents, could be the owners, quote unquote, or not the owners, but the managing members of that LLC. And then we have the limited partners, our investors. They will be the limited partners in that LLC. Limited partners don't have a say in how the property is run. The general partners are the ones that are the managing members of that offering. So they are the ones that make the decisions in how the property runs. So when I say partner up, we're looking for people. Let's say this guy John, right, found this property, okay, and he, like you said, he's got the 720 credit score. He's got experience in 16 units. He knows what to do. He's got $50,000 in cash, but he needs someone else to help him out, because when he goes to a bank and the bank is going to say, okay, John, what have you done? And John says, well, I've done 16 units up until now, but now I have 154 units. They're going to say, great, but you don't qualify as someone with enough experience or enough income, let's say, to be able to qualify to be a signer on the loan documents. So what you're going to need, John, is you're going to need to find yourself a partner who's also going to be a managing member and who's going to own at least 20% of the managing portion of the asset of the LLC. Remember, we talked, there's the general partners that get their split, and then the limited partners, the investors, that get their share. So they're going to say, well, you're going to need someone to supplement you. Find that person or people to help you to supplement what you have. So let's say John is out there and he goes to a real estate investment a meeting or whatnot, and he bumps into me, for example. And we start talking, and he says, yeah, I've got this 154 units, blah, blah, blah. And he gives me the whole thing. And he's like, I'm looking for some partners to help me sponsor the loan because I'm not qualified. I don't have the right income. I don't have the right liquidity yet. I don't have the experience. I don't have anything, but I do have this property under contract. So then I say, wow, you know what, John, that sounds great. Why don't you send me over all of your information, the due diligence, your underwriting, the rent roll, all that information that you received. I will underwrite it. And then if I like it and I'll go do a site visit and everything works out and the comparables and the market and everything that you say is true, then what we could do is we could partner up and together we will be co-sponsors on the loan.
Gotcha. And let me just ask a question here too.
Sure.
So would he even be able to get this deal under contract if he didn't qualify?
If John is a good salesman and, and he's got a good relation with the broker,
Right.
He may be able to. I've seen crazier things happen. Okay? It is difficult, especially today. Remember in the beginning I said the multifamily market is very, very hot?
Right.
So now, because it's hot, brokers, the good brokers can smell someone who really doesn't have the backing, and so they'll kind of be wishy-washy. So what I would suggest is, and my business partner Laura, she kind of said it best once. She said, doing this business is like running 12 marathons at the same time.
Love it.
And to be successful, you have to cross the finish line with all 12 marathons all at the same time. Now, what are some of these marathons? One is finding the property. One is raising money, finding a sponsor, finding finding a team that can help you, finding your SEC attorneys, putting together your property package, doing your due diligence, doing your financial due diligence, finding a mortgage broker or a lender, and getting qualified, filling out your personal financial statement and your schedule of real estate owned. All these things have to be done at the same time. So for this person, for John, to go out and to put this property under contract, that would be great. But that's probably where it would end for him because he doesn't have anything else. So before putting that property under contract, my recommendation would be, while you're building relationships with brokers, while you're building relationships with sellers, while you're doing your direct mailing, what you want to be doing as well is you want to go out and find your power team. Now, who's your power team? Power team is people that will help you, people that you'll bring into your business that have a strong network of people. You want to bring in your real estate attorney, your Securities and Exchange Commission attorney. You want to your investors. You want to start talking also to everyone you know. Okay? Now, I never ask anyone for money. I've never asked anyone for money. That's not how you raise money. The way you raise money is, I would tell John, once we have this property under contract and we've done our due diligence and we've put our investment package together, and now we have our projections and our numbers, and you're teamed up with me and my team, and this is our track record, what we do then is we take that investment summary and I just approach my entire network and I say, hey guys, you know what I'm doing, don't you? You know that I'm in commercial real estate. You know that I raise money from private individuals like yourselves and so forth. And this is the track record that we've done. We've come across an asset that we feel is an incredible opportunity. And I always use the word opportunity. I don't use the word deal. Okay? It's also in the language that we use. I found an incredible opportunity, and I would really appreciate it if you would take a look at it and let me know what you think. Okay, and if this is something for you, I would suggest that you move quickly because this is a first come, first served basis. And once I've raised all the money for the asset, for the property, it's closed, and you would miss out. And I don't want you to miss out. And would you do me a favor? Who do you know that would appreciate getting involved in something like this as well? And that's how I go out and I raise money. I raise money by building strong, deep, personal relationships with people.
So before you really even submit an LOI, you recommend that you have that power team together. And do you have within that power team, is there somebody that you, let's say, for example, you talk about the sponsorship part of it. You obviously, with a property of $5 million, you're going to need somebody that's going to have at least that net worth, right? In order to sign for it. So do you seek out certain people, that you want to have as your potential sponsor, or is that just something that'll happen organically as you start to put this team together?
Well, you want to go look for sponsors. You want to go out and look for sponsors, and that's kind of I don't want to say, well, it's easy, but it's simple. Let me say that it's simple. It's not easy. Okay. Mm-hmm. Again, it has to do with building that trust and that relationship.
Gotcha.
Okay. Because a lot of times when you're raising money from people, okay, from your network, their main concern is not how much money am I going to make on this deal. Their number one concern is, will I ever see my money again?
Right.
First, give me my money back. I get my money back, great. Now let's talk about how much money we've made on that and if this was really a good opportunity. So it's really difficult because, again, it's that trust factor. So you want to go out and you want to build trust and you want to have a sponsor on your team. Again, it's all about your criteria. Okay, if you're saying to yourself, okay, this is my criteria. I'm going after C plus assets built in 1975, between 1970 and 1978 in these types of markets at no more of a price point of $5 million. Then you need to find, it's a heavy repositioning, okay, heavy renovations. Then you got to go out and find a sponsor that qualifies for that particular type of product.
Gotcha. Now, taking just a step backward too, you'd mentioned earlier, okay, let's say you do put this power team together, but maybe you don't have enough to get this property and then teaming with another team. What does that look like? Is that a 50-50 sort of joint venture type of thing, or somebody that has done a lot of these deals already? What does that relationship look like?
That's a great question, Bill. That's a great question, and it differs. It differs from depending on what the sponsor and the team members have to do. For example, we're working with. I sponsor properties. Okay, I help people that are actually in this exact predicament, let's say, in this exact situation where they put a property under contract, they built relationships with brokers, they know exactly how to underwrite and what to look for, they ask great questions, but they haven't done a deal yet. They haven't closed on anything yet. So they come to us, they come to Laura and myself, and they say, hey guys, this is what we have, would you be interested in working with us? My next question to them is, what are your expectations for us? Do you need us to underwrite, review, walk with the inspectors? Do you need us to raise money? Do you need us to bring in our SEC attorneys? Do you need us to talk to our SEC attorneys about the PPM and the structure and help you raise money? Or do you have all that lined up and all you need is for me to ink the paper, so to speak, and to guide you and to be a guide? Because the team that I'm working with now that brought us this property in northern Florida, they've managed over 3,000 units. They've renovated units throughout their property management company that they've held. One of their members was a broker-dealer on Wall Street. So these guys know how to raise money. They understand financing. They understand renovations. They understand managing an asset. But they've never actually talked to an SEC attorney about, putting together a PPM for this kind of thing. They've never actually done the due diligence in this format. They never had to talk to a seller at Final and Best. They never had to put an LOI together. They never had to put a contract together. So, but they raised the money. They already came to us and said, listen, we've already done most of the fundraising because of one of our partners. He's a broker-dealer on Wall Street. He's got connections, and we have most of the money raised already, so we don't need that. We need this, this, and this, and this, and this. Okay. So we negotiated a certain percentage that we would take for doing X, Y, and Z. Now, if suddenly we have to raise money as well, our percentage goes up. So it really varies on what I and my team, what we have to do on the project, and that's how we split it. My team and I make everything that we do a win-win scenario. And the reason why I say this is because we have people out there, just like this guy John in your scenario here, that are going out there and they have great relationships with brokers and they're in a market where they have great opportunities and they're getting amazing, amazing properties to look at. Why would I want to screw that guy over on one deal and take everything away from him? He'll never come back to me again.
Right. So there's an advantage on your end as well.
Absolutely.
Yeah, that's smart. You're thinking ahead.
I heard Mark Cuban on the Shark Tank tell one of the presenters. He goes, "Hey, 60% of a watermelon is a lot more than 10% of a grape, right? So I'd rather get 30% of 10 assets that were brought to me than 100% of one asset that I have to go out and look for and put out my time. Does that make sense?
Yes. Yeah.
So I want to work with people that already have these relationships built. They need our support system. We're a support team, basically, because we've done it. We've ran all the marathons. We've crossed the finish line. We've raised money. We've been in tight deadlines before. We've done things that we've kicked ourselves in the head and said we will never do that again. So we have the experience. So we can take John, for example, and we can help him with everything that he has going on.
Can you give me an example of maybe a deal that you've actually done where you are like John, or as close to John? I know you always had another business, or you had your construction business, or you had some pretty good leverage position, but where you had to actually do the things that you're describing.
Sure. My partner Laura and I, we went out and after we did the flip and we made $80,000. That was a great tick on our track record. We can say that we put a property into contract, we did our due diligence, and we flipped it. So as a flip, we had our track record. As people that were able to close on a property and to manage it and to be successful, to give our investors distributions and to go full circle to actually dispose of the asset to another buyer, we had not yet done that in the multifamily realm. So what we did was we were building relationships with people, talking to people, telling them, I was talking to everyone in my network, telling them what I was doing, what I was looking for, and how they could help me. That was the key to what we were doing, how they can help me. Because if I'm just going and say, hey, Bill, you know what? I'm getting into multifamily commercial real estate investing. It's going to be fantastic. I'm raising money, and I'm going to buy an apartment complex of 100 units and up, and it's going to be awesome. You're going to tell me that's great, Nizan. More power to you. I wish you lots of success. Right? But if at the end I say, hey, Bill, what I need from you, please, okay, when you hear someone that is upset at the stock market, that they're tired of keeping their money in stocks and bonds, mutual funds, or in the bank, or all these alternative investments, or they're losing money here and whatnot, if they're looking for something new and exciting, would you please turn them on to me? Because I'm looking to raise money through investors, and I'm looking to expand my network. So I just made a call to action for you. I just asked you what you can do. Or if you know anyone who's looking to sell a property, please give them my name and phone number. I'm looking to acquire properties. Tell people what you need from them. Okay, give them a call to action. So we went out and we were looking, we were talking to people, this and that, and we had some people that said, hey, you know what? I've got $50,000 here. I've got $100,000 here. Do you have any properties under contract? Ooh, we didn't have anything right then because we didn't have the track record. We were talking to brokers, and the brokers said, well, what's your track record like? What have you done? All these things. Well, we tried skirting the questions and, not answering by answering and doing all that kind of stuff. But basically what we found was that we had to go out and team up with someone that had a property under contract and had a track record. So we found someone, a colleague of ours, and we said, hey, you've got a big raise going on. We'd like to help. We want to be a part of this team. We like what you're doing. We like what's going on. We want to get involved. How can we get involved? And they said, okay, if you're going to become a part of my managing of the general partners, you're going to have a job. You're going to have to give me market surveys every quarter. You're going to have to email a market survey of what's going on in our immediate market and in the state to all our investors. You're going to have to come up and make sure that all the distributions are paid out. You're going to have to make sure that all the communication between us and the investors are going out smoothly, doing all that. And for that, we'll give you X amount of shares in our company. We'll share this much with you. And we said, fantastic. So now we were part of the team.
Can you give me a rough idea of what percentage that deal would have fallen into for you?
At that point, I think we got like 5% of of the general partners. Okay. Now, the way it works, the way we do it, the way our fund does it, usually it works. We give anywhere between 65 to 80% of the cash flow and equity to the investors, to the limited partners. And the rest goes to the general partners. So out of the portion of the general partners, we got, I would say, I think like 5% or 6%.
Yeah, but that like you said, it's like, the Mark Cuban example. I mean, you're getting a chunk of it in exchange for this, great deal that you're putting
Absolutely.
together. Yeah,
that 5% propelled us into our success.
Right.
Because then we were able to put in, on our credibility kit, on our bio, we're general partners on this asset, which was a Class A property built in blah, blah, blah. And we, then what we were able to do is I went back to my network that told me, hey, we've got some money. And we said, great. We actually have a property under contract. We are teaming with these people. This is the track record that they have. They're the majority partners in this, okay? And we're okay with that because we've vetted them out. We know their track record. We know their success record. We're very happy with everything. And so we raised money as well for that asset. We brought our investors into that. They were very happy. They got paid their distributions. We recently sold the property as well, and they got everything. It worked out beautifully. But what it did was it gave us the ability to have a team of successful entrepreneurs, real estate investors behind us. So the next time we went and we spoke to a property manager, a real estate broker or a property owner, we were able to talk with confidence because we also, through that entire process with the other team that we teamed up with, we learned so much from being with them.
Oh, I bet. God, that's great.
On the job training, yeah. It's fantastic. So we went on, and after that, once we had our success with that, we had someone like John who went and built a relationship with a broker for 2 years, and then that broker sent him an off-market property, 224 units, $6.7 million. We raised the money. I was able then to, we had built our net worth and whatnot. I was able at that point to be the sponsor on the loan. I wasn't able to sponsor the entire deal alone, so we brought in a co-sponsor as well. And she was the type of sponsor that said, Nizan, I trust you. I know what you guys are doing. I know Laura. I trust you guys are going to do an awesome job. All I need to do, I just want to look at your underwriting, make sure it's okay. And then she just signed on the dotted line. She and I became co-sponsors, and Laura and I ran that property. The gentleman that brought us the property, he was out there. He was with there doing us the due diligence. He was with us raising capital, and he got the experience from that as well.
Gotcha,
So we did that, and then we helped someone do that as well, and that's what we do now as well. We help people just like this scenario, just like this guy John. We helped him cross the finish line.
Oh, that's great! Wow. I mean, right after you had somebody help you do the same. I mean, that's really neat how that kind of comes back, and there's that. It's all relationships. It sounds like
Absolutely.
really building
Absolutely.
those solid relationships.
It is.
This has been such great information, Nizan. I think this is going to be a very strong informational podcast for us that a lot of people are going to want to hear and dissect too. I think there's a lot of great information here, and we have very detailed show notes where we'll outline everything that you've talked about here, so that somebody can also look at the written side of it as well. So that will be helpful.
To all your listeners out there, it doesn't matter where they are in the country. If you're investing in your backyard, if you're looking to invest in another market, and you have a property that you are looking at, and the broker sent you the information, and you're kind of wondering, what do we do next? How do we underwrite it? If you're looking for a sponsor, if you're looking for anyone like that, please feel free to drop me an email. Okay, my whole business model is how many people can I help achieve success in this industry, in this business. If I help 10 people close on an asset, well, I've just closed on 10 assets myself because we're partners. So feel free to drop me an email, tell me your situation, where you're at, what you're looking for, what you need, and hopefully we can work together on this, on some of the opportunities.
Great. Well, at the end here, I'm going to go ahead and ask you, that information, how people can contact you. In somebody approaching you, now, are you counting on that person to have done the due diligence, to have a deal in hand, or it could be a much colder process where, well, I've got a bunch of different properties, but I'm not really sure which ones are good or not. I mean, how far along in the process do you want that person to be that approaches you?
Well, in a utopian world, I would like the person to be able to at least underwrite the property, underwrite the financials. If they're just really getting started and they don't know anything and they're talking to a broker, it's kind of hard because I'm getting a lot of properties myself and it would just be like another broker sending me an asset. If somebody is getting involved now, what I would suggest is shoot me an email, and we could either set up a conference call time that we can talk, and I can share with you my underwriting template, and then you can go out and underwrite using my spreadsheet, and if the parameters, if the green lights start flashing when you're underwriting, and it's in our parameters, then send us the underwriting and the information. But generally, what I would like is for people to have some working knowledge of multifamily and how to underwrite it in some ways. Obviously, people underwrite it differently, and that's okay. But I would also like to get involved before you send out your LOI on a property that you've put an X on.
Gotcha. Oh, that's great.
And the reason is because we probably have a lot of things in our LOI due to experience that they would probably not have even thought of yet.
That's great. Great point, because, you don't want to be locked into restrictions that somebody else had in their LOI.
Right. Exactly.
Okay, that's fantastic information. In your underwriting template, are you strictly looking at financials, or do you have market information in there too? So, for example, you want to make sure, as you'd mentioned, that this is in a good upcoming market, an emerging market. Do you address that in your template, or is that's a separate assessment?
That is going to be the homework of whoever's looking at at acquiring an asset. So whoever's looking at and talking to a broker, you want to make sure that you get the comparables, the comps. You want the rental comps and the sales comps. Now, if you're buying a 1975 property that has not been upgraded and needs renovations, don't send me you can send me a comparable that is 1975 built that has been upgraded already. However, don't send me a 1995 property.
Right.
1995 and 1975 are two completely different animals. Mm-hmm. Okay? Now, if you're telling me this is the only 1975 property built in the neighborhood, okay, let's see what's going on in the neighborhood. And the reason why we want the comparables is because it's very easy to say, like on this example that you say here, the rents are below market. Well, who says the rents are below market? Is it the broker telling you? Brokers want to sell a property. They'll tell you whatever. A broker will tell you, wow, you could just come into the property and raise rents immediately at $100 without doing anything. Every broker will tell you that because they want to sell you the property. The real deal is that's very difficult to do, to raise the units $100 depending on what you're doing and so forth. It's not impossible, but it's difficult. But we need to know what the market is doing. Can we raise the rents 100? Is there another property that has done this already? For example, the property in Kentucky and the property in North Florida, we have strong comparables that show us that if we go and we do the renovations on the property, we can raise rents between $150 to $200 easily, and bring the property up to market. Now, How else do we go about checking the comparables? We go and the person that is gathering all this information should go and find 3 separate property management companies in that market and call them and ask them about the asset and about the market. What do you know about the market? How many units are you managing in this area? Have you done any renovations? What do you see the issues being in this market or on that property? Have you ever managed this property before? What have been your issues before? Or you can, what I like to do also is when I talk to a property management company or even to the broker or even to the management company that's managing the property right now, if you get a chance to speak to them, a great question would be, if you had unlimited money available to you right now, what would be the top 5 things you would do to this property? And then hear what they have to say.
Wow. So it would have to be a property manager that's familiar with this property, obviously.
Right.
Yeah.
Right.
Okay.
Mm-hmm. Mm-hmm.
God, that's great. That's great stuff. Man, this is really some excellent information, Nizan. Wow. Anything you wanted to add here, looking at this situation, getting that first big deal funded, getting that first deal, anything that you missed that you think maybe you should mention here?
When we're getting started in this, people talk about 100 units, like, $5 million, $10 million. Oh my God, that is so big. Oh, I don't know if I can do that. When you have the right team with you, you can do it. It may be scary. With the right team in place, you can be very successful. And don't try to do this alone. It's very difficult to do it alone. The roller coaster ride is very emotional, very taxing. There's a lot of things that you have to do. Myself, I am a big picture kind of guy. I'm a relationship builder. I talk to. I'm great at networking, at building the vision, at doing all that. My business partner, she's great. She's great at doing that as well. We're both very intelligent people. We both understand spreadsheets and numbers and projections and things like that. However, her skill, she has she has 2 masters in economics, one from the University of Orleans in France and one from the University of Miami. So she knows spreadsheets, she knows how to analyze, and she's amazing with numbers. So together we complement each other. So when you're looking for a partner or partners, don't look for people that do what you do. Look for people that do what you don't like to do or what you're not good at doing. And then team up with these people. And team up with people that you like, because you're going to either, when you're successful, you're going to be successful with these people. So do it with people that you like and that you trust. Build a team.
Great advice.
Build a team. Yeah, build a team and get out of your comfort zone. Talk to everybody. Tell them what you're doing, and never, ever ask for money.
I love it. Great advice, Nizan. Wow. This has been a powerful, powerful show. And I think that this is going to be something that I think is just good. Again, it just provides information here that is just practical, applicable, that people can grab onto, and I think you kind of bring it home too, where, like you said, people look at, oh man, I can't imagine buying a $10 million, $20 million property. It just is out of my realm of understanding, and yet I think you kind of bring it home so that people can actually get their arms around it, which is exactly what this show's about, and what we're trying to do for those that are listening out there is to show you that you can do these things. You can acquire properties. At one point, the people that are acquiring these properties were at the same place that you're at, and because of that, they had to make that step. They had to build these teams that help to leverage them into larger properties and better equity positions and so forth. So this has just been invaluable. And let people know, how can people reach you? What's the best way to do that, Nizan?
The best way would be through email. And if you email me and I don't respond within 2 or 3 days, that means I didn't see your email. So just shoot me another email. And my email it's nizan@investwithcip.com, and I'll spell it. That's N like Nancy, I, Z like zebra, A like apple, N like Nancy, at invest with, and now it's 3 letters, CIP, Charlie Indigo Papa.com. So Nizan at investwithcip.com. And CIP stands for Cornerstone Investment Partners. You can also go to my website, www.investwithcip.com. My partner and I, we also started a real estate fund. It's called Jade Capital Partners, where we're raising money through family offices, accredited investors, qualified investors into our real estate fund. A great vehicle to use to invest in real estate, in multifamily, is your IRA, your self-directed IRA. You can invest as a limited partner or general partner, your money that's inside the IRA, and then any money that comes out, distributions and whatnot, goes back into the IRA. Depending how you set it up, it's either tax deferred or tax free. So how would you like to make you money, and have it tax free or tax deferred?
That's great. So using our example of John, the guy that we used in our example, if John had that $50,000 in a self-directed IRA, he could still invest that, even though it would benefit him. Because I know the self-directed rules are a little unclear. He could use that for, let's say, the earnest money deposit to get into that. How would that work?
He could use that for his earnest money deposit. He could use that if he wants to come in as a limited partner and as an investment. Okay, you can do that. All you would need to do is you would need to have the sponsors or the general partners. Actually, what you would do is you would go and talk to your custodian company, okay, the IRA custodian company, and ask what documents that you would need for you to be able to have them release the funds into that opportunity, into the investment. You sign those documents. The sponsor would have to sign the documents, the managing members, and you send it back to your custodian company, and then they would release the money into the escrow account. And then it's your money. You can do with it what you want. The money, the distributions and from cash flow and your profit sales will be then distributed back to you into your IRA. Now, if you're in your 60s or whatnot, if you're retired already, and you're using that money, then that's money that you can use immediately. If you're someone, like myself in your 40s and you have your IRA, you can invest that money, and then your IRA will grow year by year, and you will not get penalized on taxes if you wait until retirement age to pull that money out. So you can build your retirement fund tax-free.
That's great.
By investing in commercial real estate.
So on the earnest money deposit, would they, after closing of escrow, they'd get that back and then put it right back into the IRA? Is that right? How that would work?
We have investors that we raise money for the earnest money deposit, and when we close on the property, we raise money, and then that money gets transferred back to them, or sometimes they keep that money in the game and they use it as an investment. And they say, you know what? It became an earnest money deposit. Now we're closing on the property. Keep my money in there. I want to receive the distributions and the profits just like anybody else.
Okay.
So, it depends on how you want to structure it.
Okay. So that could be part of their share in the deposit. Okay, great. Good information. Oh, this is great, Nizan. Fantastic show. Well, we're going to have to wrap it up now, but I know we're going to have you back again. There's so many different areas of value. Thank you so much, Nizan, for taking the time to join us on this. And really, I mean, this is a very clear, concise explanation. You've definitely got teaching gifts here because I think you presented things very clearly that our listeners would grasp and definitely value from. And for all those that are listening, our old dog listeners out there, we really appreciate. We know there's a lot of things you could be doing right now, and the fact that you've taken the time to join us here at the Old Dogs REI Network is something we really appreciate, and we value that. So that's the show for today. As we had mentioned a little bit earlier here that Nizan was on an episode before. It's episode 025. So I'd recommend that you listen to that. That gives you a lot of his background and how he got started in real estate investing. So that would be value to you. This is the Old Dogs REI Network. Remember, cash flow is king and real estate investing the means. Until next time, keep moving forward and may God bless.
Thank you very much for visiting the Old Dogs REI Network. We would greatly appreciate if you would stop by iTunes and let us know what you think of the show. We would love if you could subscribe to the podcast, give us a 5-star rating, and write a review. The more ratings and reviews we receive, the more visible the podcast will be to others. Thank you.